Next Big Thing HQ, the flagship podcast. And we are welcoming on today a very interesting guest, Kevin Fullmer, known to equity crowdfunding Twitter as Crowdscale or at Crowdscale1. I guess it's X, not Twitter anymore. I feel like I have to start getting my brain wired to say X. But we welcome on Kevin Fullmer, and we are super excited to have him on. Me and Connor have been a big fan of his content and his newsletter that he's been putting out. There's a ton of good equity crowdfunding content, and not just content as relates to that industry, but practical investing content. For the episode we were talking, Kevin was talking about his background, talking about public equities and writing about public equities. So I think you guys in the audience out there are really going to enjoy getting to know Kevin. So with that being said, Kevin, thank you for taking the time, and welcome on Next Big Thing HQ.
Thanks for having me, guys. I've come onto your work in the last month or so, and I really like what you guys are putting out. There's not a lot of voices in the equity crowdfunding space, so it's good to have, two more.
Thank you.
We appreciate it, and we appreciate you coming on. You have by far the best content newsletter-wise with equity crowdfunding. There's so much value, and even just going through your website, rating the startups. We'll get into that later. But I always enjoy reading it, and I can't wait to read the next episode or the next newsletter that comes out. Now, tell us a little bit about how you got into equity crowdfunding and kind of the story behind that.
Yeah, of course. We were chatting a little bit about this before we started recording, but I was one of the early adopters of Robinhood, the stock trading app. That came out, I think, maybe when I was in high school or early college, and I loved it. I thought it was super cool and completely democratized being able to invest in public equities. It previously didn't really make financial sense to do so unless you had a lot of money to invest. So I started investing in stocks, and I was really into it. I started writing for a publication called Seeking Alpha, just detailing a couple of stocks that I followed. And I came across the world of equity crowdfunding, I think recently, like after I graduated college. And, being able to invest in startups was just such a novel concept at the time. To me, when I first joined, I was like, oh, you obviously have to have like $1 million in the bank to even think about investing in, investing in startups. And through equity crowdfunding, that's totally not true. You can have $100 to your name. And I wouldn't recommend investing in equity crowdfunding if you only have $100 to your name, but that's all it takes to get started. And so I think I dipped my toes in. I probably invested in one startup a year for maybe the first 2 years. And then in the last 3 years, I've really picked up my investing now that I feel a little bit more confident in my ability to evaluate companies. And that led me to creating Crowdscale because, it is such a novel, like equity crowdfunding is such a novel and nascent industry. And there really wasn't a lot of content being put out in the space. And, given my background writing for Seeking Alpha, I was like, why not I be the content? And I think the reason it's been successful so far is because it's extremely relatable. Like I'm not writing Crowdscale as a multimillionaire who's sharing all the the tricks of my success. Like I am like everyone else going through it at the same time and just detailing my journey and putting 300% effort into it so that I can share some, valuable takeaways for the audience.
Yeah, well, when you talk about being relatable, and the bio for your YouTube channel says a non-millionaire investing in 10 plus startups a year and sharing my findings as I go along. And the only thing I want to add is a non-millionaire yet, soon to be, not yet, but just going off that, what have you discovered kind of investing in these startups? And you talked about valuations earlier. How do you evaluate these startups?
Yeah, well, before we get into that, it's funny how many I get a lot of backlash for that tagline about a non-millionaire.
Wait, why?
Because there's so many people that like come across and they're like, why would I ever take investing advice from you if you're not a millionaire? And it's like, it's not worth my time to like respond, but like, with startup investing, it takes like 7 to 10 years for these startups to
Right.
exit. So like I am making the moves now, and I'm not gonna, there's so many influencers out there that like rent a Ferrari for a day and then like do a whole photo shoot to make it look like they have tons of money and all this, and it's extremely misleading. I am not trying to flex wealth in any way, shape, or form. I'm just detailing my personal investment journey. And hopefully, the goal is to be a millionaire later down the line, but I'm not there yet. I'm just making the steps to get there. And the second point, you guys, I saw your tagline on Twitter, and I have a correction for you guys. You guys have, I think you wrote, wannabe investors via equity crowdfunding as part of your byline. Have you guys invested in any of the startups through equity crowdfunding?
I've invested
too.
Yeah.
Okay. Well, then remove the wannabe. Like you're doing it. Like that is investing.
That's a good point. See, we appreciate feedback like that. When we bring people on, we had a friend of ours that helped us with a couple episodes a couple weeks ago, actually last week, I think, and we love that feedback. So I think you're right. I mean, I think kind of to go off your point about trying to be relatable, I think that's kind of what we've tried to portray is being, entering into the equity crowdfunding space, not necessarily knowing much, and we've learned a ton in the last, I don't know, has it been 8 months, Connor?
Yeah.
And like there's a fine line to walk when you want to be relatable, but you also want to show your expertise and grow your audience that way. So I think that's really good advice.
Well, and I guess it goes to the original mission. Brendan and I started this. We wanted to make money so that we could invest when we were students in college, so that we could invest in equity crowdfunding. So yeah, I guess now, because I still haven't, I need to. But now that I started working, I have money on the side, so I'm going to start investing. So I'm excited about that. But Brendan has, so we'll change it to like 0.5 wannabe investors.
Something like that. So, Kevin, you talked about, when you started out, you were doing one investment a year, and now you're kind of doing more. I'm interested how the landscape has kind of grown and how it's developed from the time you started as an equity crowdfunding investor to where the ecosystem is right now.
It has grown by leaps and bounds. So equity crowdfunding came about in the US in 2012 after the Jobs Act was passed. That basically let anyone invest in startups if the startup was listed through regulation crowdfunding. And it kind of had like a black eye for the first years of its existence. The perception was if you're doing equity crowdfunding, it's because you can't raise money from venture capitalists. And because of that black eye, you weren't getting the highest quality startups that were doing crowdfunding. If they were really high quality, they were just getting VC money. And so the deal flow that everyone was getting early on was pretty poor and pretty bad. And luckily, I believe we've turned the corner in terms of that. You've seen Substack, which is like a top startup that already had VC backing. They've raised through equity crowdfunding. Replit, I don't know how to say it, but they were a pretty high flying startup that decided to do a community round on WeFunder.
Oculus, right?
Oculus, maybe. I think Oculus, what that started out as was a crowdfunding product on like Kickstarter. That might be what it was.
Equity crowdfunding. They were crowdfunding for. Right.
Yeah.
Yes.
Exactly. So I think part of the reason I wasn't, going full on early on was just the startup quality wasn't really there. But I've been blown away by like how many like quality startups there are out there right now. And every metric over the past 3 years is up in terms of like how many investors are participating, how much the average startup raises, and like how many deals are like live at any given point. So there's a lot to be excited about, I think, and it's grown immensely from when I first dabbled in the space.
So I've invested in 2 deals myself, as I just said, and I think my first 2 investments were basically more on investing in what I know. Could I look at this startup and see could I see myself using this product? And the answers to both of those questions were yes. And I think as I've now in the last few months not made an investment, I've had a chance to really dive into more metric based and fundamental based ways to evaluate these startups. So maybe for the people out there listening, how have you developed the way you look at startups, and what are those kind of key metrics you look at?
Yeah, it differs. The metrics specifically differ by like what industry
Mm-hmm.
you're looking at. Like a direct to consumer online business, you would look at like how efficient is their customer acquisition costs, how like what do their margins look like, stuff
Right.
like that. But that might be entirely different for like a B2B SaaS business.
Right.
So like metrics, they vary from like one startup to another. In terms of like what stays consistent, like the founding team is something I used to like overlook it a little bit. And now I realize that like that is the engine that makes it grow. Like you could have any guy on the street like invent Tesla, but will it be successful unless it's Elon Musk who's like sleeping at the factory floors, like, just shoving it through to success? Probably not. So the founding team is extremely important. And for that, one of the things that I look for, it's okay if they don't have experience, if this is their first time founding company. There's a company, there's been multiple cases where that has gone well.
Mm-hmm.
But I really do look if they have past success, because like you can check off the box for like charisma, focus, leadership, all that. If they have a successful startup under their belt already that they've sold and or has gone public or something like that, you can kind of like pre-check those boxes, because you can't get a startup to a point of success unless you have all those boxes. So past exit success is something I really hone into with founders. And one of the great things about equity crowdfunding is like you can just reach out to them and ask them questions. You can even get on a call with them. I've talked with I want to say at least 20 founders now, mostly for interviews for Crowdscale. But you can leave a comment on their fundraise page. You can ask them to just get on a call and chat through it. So it's extremely accessible ecosystem that you can tap into. In terms of what else I look for, so basically, when you look at a startup's fundraising page, that is just an ad. It's an advertisement, and you have to be in that mindset that you're looking at an advertisement.
Mm-hmm.
And so there's probably a lot of good information on there. They do need to sell you into the company, and its future potential, but it's an ad at the end of the day. So what I recommend is looking at it through that lens, and then also going to their Form C. It's like the documents they have to register with the SEC. That usually includes the past 2 years financials, as well as how much ownership of like the company does the founder have, like what are their debt obligations, a lot of really useful stuff like that, what they plan to do with the funds exactly. So I would highly recommend going through the Form C and giving that a look, because that's not an ad. That's like facts and just raw data.
What about common red flags?
Common red flags. Oh, I tweeted about this yesterday or a couple days ago, but if a startup ever says how much revenue they have and it's total revenue, not revenue growth, red flag, because that usually means that they don't have positive revenue growth year over year.
Mm-hmm.
I don't mean to put them on blast, because I actually ended up investing in them, but the Sill, which is an online plant retailer, they're sort of blending the physical world with online for house plants. On their fundraising page, which is an ad, they put, "We have done 50 million sales lifetime." Whenever you see lifetime or total, it's like, well, I don't care what you did 3 years ago. I want to know what you did the year before and what you're doing this year, because that's showing the trend of the company. And it turned out that their revenues were going down. Now, there was a lot of factors involved, so I ended up actually investing, but it was good to understand the risk and just be aware of it. So that's a red flag. Another red flag, let's see. I guess just like every startup likes to show the up and to the right graph of like, this is what our revenue is going to look like. And like, it's easy to get like, carried away as an investor, be like, wow, they're going to do like 100 million sales in 5 years. That's great. And it's like, you got to remember, like, those are just projections, and they're usually projections made at like the loftiest of
very, very aggressive, right?
yeah, it's like if everything goes perfectly, like this is what we're going to do. So you got to like make kind of your own projections using what you do believe to be true to really like ground yourself in what's feasible. So I say those are two that I usually look out for. Also, just, I mean, this goes into like just basic due diligence, but always like research the founder. Just do a simple Google search of their name. And like what I like to do is, let's say the founder's name is Bob Smith. I'm going to Google. First, I'll just search Bob Smith by itself, but then I'll like search like Bob Smith crime, Bob Smith fraud, Bob Smith, like all these like bad words to see if anything comes up. Because, you know, you could just be like, what if the article is like Bob Smith is a fraudster who like defrauded all these investors like 5 years ago? Then you'd be like, okay, I just saved myself my entire investment by not investing in him. You know, could have been caught with a red flag. There's a company called City Zenith that did an equity crowdfunding round, or a couple of them, and if you Google search it, there's a couple articles that come up. Super shady company, super shady founder, and he basically is like defrauding and harassing investors. So if I think they did like one of the raises they did in the last like year, if you just Google search that founder's name and that article popped up, like you would have saved yourself from a pretty poor investment.
So when I first encountered Crowdscale was the article about Weagle that you did. And that was one of those where I was the first time I encountered newsletter, but one of the first times I'd ever thought about the ugly side of equity crowdfunding.
Mm-hmm.
And I want you to kind of talk about that, because I thought we received 2 responses from equity crowdfunding founders about how interested they were in that article and how shocked they were at that article and how thorough it was as well. So can you talk about that article and maybe talk about the ugly side of equity crowdfunding that's kind of out there?
Yeah, for sure. And it's never my intention to like put down a founder if I believe they're like genuinely doing good or genuinely trying to achieve what their business is set out to do. I like, there's so many startups that I pass on, but I don't write about them. You know, I do write about some of them, but for the most part, I try to like not like totally put cold water on like people's dreams. I do it every now and then just to like, you know, keep a healthy, you know, slate of content. But
and you have to protect the investors, right?
Yeah. So the ugly side of crowdfunding is like, if I was a bad actor, if I took my fake startup to VCs, they would see right through it. These guys are trained, and these people see 100 startups a day. So like, you're going to get 0 investment dollars from venture capitalists most times. But so what I would do if I was a bad actor, I'd be like, well, why don't I go to like the uneducated part of the population that like doesn't know how to invest in startups and just pitch my startup there. And that's exactly what I think Weagle, I don't know how you pronounce it, but that's what I believe they're doing. There's been a lot of documentation around how like this technology has just been proven to like be impossible, like physically impossible. And that they don't even use like their own devices for quote unquote like demonstrations. They use like these third party devices. So like, and it doesn't even work. But anyway, I'm getting worked up about it. But what they're doing is I don't know if you guys get served ads on Instagram and Facebook for them, but I get so many Wiggle ads.
I get a few, yeah.
Yeah. So basically what I think they're doing, and this is just based off of what I've like seen, is I think they're just running a marketing campaign, a profitable marketing campaign. So basically they spend $100K on ads. They probably get $300,000 in investment off of that. And that's $200,000 in the bank that they get to, you know, just pocket or, you know, pay their salaries for another year so they don't have to do anything. So I'd be wary of a lot of startups do have to like do advertised-based marketing, but I'm a little bit cautious of the ones that are just doing it nonstop. And it's mostly to like just fund their operations. Yeah. They're like fake operations, you know?
So I do want to kind of get back to Crowdscale, the newsletter you started. you have a startup rating system where you kind of rate the startups, and you just talked about investing in the SIL. So can you walk us through what the startup rating was for the SIL and why you invested in the SIL? Because I find the SIL a very fascinating startup. The fact that, it has, even though you don't like the lifetime sales, the fact that it has sold $50 million in sales selling houseplants still blows my
Yeah.
mind. So can you just walk us through kind of that process, how you rate these startups, and why you decided to invest in the SIL?
Yeah. So, and you're probably seeing the startup ratings on the website that I have. I've I've kind of let the website be dormant for a little bit, just because my original intention was like I'm going to rate every single startup out there,
Mm-hmm.
so that they're all like by the same sort of metrics, and you can kind of just like out of a score out of 100, like compare startup to startup. Um, there's like 400 startups out there raising through their equity. So it's like I if I were to review all of them, the quality of the review would go so far down,
Hmm.
and I didn't want to compromise that quality. So I was like, okay, I'm not going to review all these startups and whatnot. So I kind of did away with the score out of 100 rating a little bit, and it's just a little less like yeah, it's not one out of 100 anymore. For the SIL, so this one really interested me because like the plant market is huge. It's absolutely
Really?
enormous. And I was so shocked to find out that there are so few players in the digital space for houseplants. There's one other one that's Bloomscape. They're like the only online competitor that the SIL has that has any sort of volume. But the SIL is larger than them, so uh, I believe that the SIL is going to continue to be the category leader there. And if they can be the category leader of the indoor house plant market that is growing pretty significantly online, there's going to be a lot of value there. Now, their revenues have been going down for the past couple of years, but there's a couple of reasons for it, and I felt comfortable with those reasons enough to invest in them and recommend investing in them. One, they were faced with a lot of product shortages. Specifically, they couldn't even get like pots shipped to them. Like there's toilet paper and paper towels on the shelves, but like for businesses getting goods, it still takes a long time for them to get some of the products that they need. And the SIL experienced that rather sharply. So that was one. The second is that they were just really veering towards profitability, which is a smart move, in my opinion. When you position yourself for growth, it's kind of grow at all costs, and you put a lot of money into marketing, you put a lot of money into all other places so that you can just grow like a rocket ship. And then when you pivot to profitability, you kind of take away all this nice stuff, and revenue either flatlines or it goes down a little bit. In the SIL's case, it went down a little bit. But if you take a step to like zoom out for a little bit and look at like a 7 to 10 year horizon, I think that houseplants are obviously going to remain like a huge thing. I forget if I put it in the article, but like even down to like Maslow's hierarchy of needs, like at first humans cared about like food, water, shelter, and we still care about that. But once you have that, you sort of form the base of the pyramid, and you go, all right, what's the next step? And you're like, okay, now I want like friendly connections and stuff like that. And then it's like, oh, I want, spirituality and stuff like that. And plants have been tied to a lot of like mental health benefits and stuff like that, stuff at the top of the pyramid. That's why you've seen like there's been a lot of startups like Calm is now like a multi-billion-dollar company. That wouldn't have existed 100 years ago. People were still at the lower bases of the pyramid, just like trying to get by. But now people are really tuned into mental health, spirituality, and stuff like that. And plants have a role in that space, and I think it's going to continue to grow in importance. Also, as we're more digitally tuned in, it makes sense to have those physical connections, those physical plants around you. So long term, I think that houseplants are going to be very important. I think there's a ton of opportunity for them to grow in the digital space. Because right now I think it's a very small percentage of houseplants are bought online these days, but it's going up. And then the third thing is I think they're the category leader and will continue to be the category leader. So long term, I think there's a lot of value in the space, and they mark their valuation very low relative to their revenues. Usually you would price a company of their size at like 5x revenues, something like that. They price their valuation at like 0.7x revenues or 0.5x revenues, something like that. So it was extremely well priced, and I believe in their long-term future. So that's a very long-winded answer of, explaining why I was behind them. But
And I do think it helps a lot with their following on social media. That's a big thing for me if I see a D2C company that has that big of a following on social media, because it makes, when you have that large of an audience, if you can figure out how to monetize it the right way possible, they will become advocates, and then you'll get more and more support, and you already have that many people kind of following you in the first place. So I think they can figure that out. It helps with them, that kind of makes them the market leader because they have that much attention every single time they post on social media, that much more attention than their competitors. And then I think too, maybe pricing it relatively low for the valuation, it might help just because they want investors to become consumers or buyers and then become advocates of their product. And they think they can grow and scale much faster that way in a very profitable manner.
Yeah, having an organic following is huge, because you could either run a marketing campaign where you have to pay for those views, or you just post for free on your own channel. So having an organic following is really massive, and it can save you a lot of costs.
Yeah.
So when I think about equity crowdfunding, right, there's so many ways in which it can grow, but there are a lot of hoops to jump through. Like, there's definitely a lot of steps that need to get there. And it's why when we had Ian Lowe on, the episode actually released today, but when we interviewed him, I was so intrigued because he was it was such a transformative solution to put more startups in front of more people's faces, right? What do you think is the biggest barrier to making equity crowdfunding more mainstream? Might be the wrong word because there's definitely a huge ecosystem, but what's going to happen to make it more mainstream, or to a retail investor, somebody who, was part of the Robinhood fervor, and, somebody that hasn't been exposed to equity crowdfunding yet? How do we get there?
It will be tough. I'm not going to sugarcoat it, because like it's a really hard thing to grow exponentially, because the majority of startups fail.
Right.
So when they fail, in most cases, you're getting a 0% return. And so if you were pitching something to someone, in this case, equity crowdfunding, they're like, yeah, I'll try it. And like, they try their first 2 investments, and those both like go to 0. It's not like a 20% decrease. It's not a 30% decrease. It's 0. So that's like a hard like reinforcement cycle of like, okay, that did terrible. Should I do that again? And unless you have like enough education where you tell people like you need to have a diversified portfolio, hopefully around, building up to like 20 startups, because a lot of them will fail, and the ones that succeed will hopefully more than return the rest of your investment. But that's a hard thing to teach people. And so it's going to be tough. I mentioned earlier, like at first we were having like equity crowdfunding wasn't getting like the highest quality startups. So we've passed that hurdle, in my opinion. That was one of them to help go mainstream. I think another one that will help is if like equity crowdfunding needs a big winner. Like we need like not a Tesla level exit, but like, I don't know, like a pretty big win. Like, I don't know, like the size of like Snapchat, like something like that. Like if that exits at a multi-billion-dollar valuation, and like equity crowdfunding investors get rewarded immensely, that is something that the industry can point to and be like, yeah, like you lost money on that one, but like this can work. You just have to like get enough shots on goal to have a chance at success. Because right now, I don't think they have one where it's like it's just so far and clear away. Like there have been some wins, but nothing like massive that like everyone knows the name of, and you can just point to that. So that's one thing. I also think that the industry needs to do a much better job of founder communications. So in my portfolio, I have about 35 startups, something like that. There's a handful of them I've never heard from the founders after investing in them. And sadly, that's like the case for, a lot of these companies, is that you invest in them and then, you don't hear from them again. And it's a really bad feeling that way. And if the company also ends up going broke, like it busts, then you just feel kind of like scammed, because it's like it'd be one thing if like along the way the founder was sending email like, hey, we're working on this, we're changing this up to try and right the ship, this is something we're excited about. That'd be one thing. You'd be like, okay, they gave it their best shot and just didn't work out. But if you don't hear from them at all and then poof, they're gone, it's like, what did I put my money into? So I think there needs to be more accountability on founders to come up with some sort of cadence to update investors.
Yeah, I mean, I agree with that. I think like one of the biggest discussions I have with myself, and actually me and Connor talk about, is like equity crowdfunding as an industry would be so great if we could get more people into it. But I feel like with more attention, there is going to be more conversations about regulation and what we should do and how we should protect people. And that's where the accredited, non-accredited investor thing comes into play as well. I think the biggest hurdle for equity crowdfunding right now that I see is that there is a considerable lack of framework surrounding valuation, in a sense of like you talked about venture capital, right? Like, those people know how to value a startup. Those people know when somebody's like full of crap. But a retail investor is not equipped with those tools. How can we equip a retail investor with the ability to value a startup the way that they can log onto their Schwab account and see like, oh, these experts think that this is a buy and this is a sell? Do you think that there's a path forward to that? Because I struggle with the valuation thing. I feel like it's such an important part of returns when it comes to startups, right? If you get the right startup at a wrong valuation, your return's going to be kind of crappy, right?
Yeah.
What are your thoughts on that?
Yeah, it's an interesting question. I think some people are working on it. King's Crowd and Hubtoss are two of like the data players in the space, and with them you can kind of see all the startups in a industry like lined up side by side, so you can sort of compare valuations at certain revenue thresholds to see like what is a reasonable valuation and whatnot. So they're scratching at it. But I think venture capitalists have a you can just Google search like average pre-seed investment, average seed investment, Series A investment, and it'll tell you kind of like what the average valuation is. It's a tough problem to solve though, because like there's so many factors that go into it, and these are such early stage companies that like it's not just data that you can kind of like put into a calculator and spit out a number. And that's kind of what I like about it. Like it's there is science, but it's a lot of art too.
Double-edged sword. Yeah.
Yeah.
Like it's definitely like, when you log into, invest in public equities, whether it's Schwab, whether it's Fidelity, whether it's any of that, you get the same data on every platform pretty much. But on WeFunder and Start Engine and Public, and could go on, there's different things thrown in front of you because, and I never thought about it this way, it's an advertisement. And there's totally different ways to look at it on different sites. So I think that that's like a really cool thing, as you said, because it allows somebody that's really into it to really have a fun time digging into a startup and trying to find this data, but it also can leave people susceptible. So, I think that's a great point.
Yeah, and I think one thing you can do as an investor is just look at enough startups. Just even if you're not interested in investing in them, just pour through them, see what they're about, see what their revenues are like, how quickly they're growing, and then compare that to their valuation. And over time, you'll just develop a knack for like, you can just look at it, look at the revenue, like look at the revenue growth and the profit margins, and then look at the valuation, be like, that seems too high or that seems too low. I think I'm starting to get to that point where I feel a little bit more comfortable being able to just eyeball it for like an initial take of what the valuation looks like.
So, Kevin, what are you most excited about going forward in the next 5 to 10 years with equity crowdfunding?
I think you're going to see some big exits. I'm optimistic of that, especially if we look at like a 10-year horizon.
Yep.
Because like 2012 was when this industry first came out, but like those first 4 years, maybe even first 6, 7 years, that batch of startups probably wasn't the most high quality startups. So they have a less chance of going big. I think now that like we're getting some big names to, commit to equity crowdfunding as an investment vehicle, in 10 years, you're going to see some of those have an exit. So I think that's what I'm most excited for. Because everything else, like it'll just grow slowly, but like the exits are what's like a big splash, in the space. So it'll be exciting.
That's when the win happens, right?
What's that?
I said that's when the win happens, right? When you get the exit and then you see, oh, I made 10x my money. All right, that's super exciting. Yeah. And it's a win for the startup too, because the startup finally made it. Finally got the exit.
Exactly. Yeah, so, exactly. Mm-hmm.
And I think what I really like what WeFunder's doing with YC, where they're kind of pairing up and they have their own YC filters, so you can look at the YC founders. And that goes back to your original point. When you are investing in startups, you want the founder to usually have some sort of experience. It's pretty hard to have a very successful startup without having any previous experience. And at least knowing that you can invest in YC founders on WeFunder, the YC trains these founders very well and helps them understand, okay, here's the fundamentals, right? It's like going to Duke as a basketball player. The basketball player is going to have all the fundamentals down. And so I think that's really exciting. And I think that partnership is only going to grow and get bigger and bigger. And it's only going to lead to better and better startups coming into the equity crowdfunding space in the future.
Totally. I mean, how crazy is that we can invest in YC companies? Like that is the cream of the crop. So that's huge. And just goes to show you that, equity crowdfunding isn't just for startups that can't raise VC money. It's for startups that just want to.
Well, so I was talking to the CEO earlier today, and he was telling me he thinks going forward in the future, a bunch of subsidiaries of actual public companies are going to start doing Reg CF. So they're going to start selling some of their ownership in these subsidiaries via Reg CF, via crowdfunding, so that we can actually invest in subsidiaries and then get actual shares in the parent company. I was like, that's pretty interesting approach going forward, just because they want, yeah. And so if he's saying that, he's probably thinking that in his head. I'm sure a bunch of other CEOs are thinking about that in their head, which then makes you think, okay, does that mean Reg CF going forward is not just for startups, but can also be maybe for like a subsidiary of a public company? Maybe Tesla wants to take this Optimus subsidiary where they're building the Optimus robots and make that kind of a Reg CF round, so they can get more people, advocates and investors to help grow awareness, to help grow people kind of committed to that company. And I was thinking, that's a new possibility. I don't know how well it will play out, but the fact that people are talking about it kind of shows you how many doors Reg CF can open up going forward.
Yeah, that's really interesting. I don't know if that'll happen. I might be a little bit more pessimistic on it, but I mean, in some use cases, I mean, it'll be cool to see it happen.
So I was going to say me, but let's use Connor as an example since he hasn't done any investments yet. All right. So he's starting out. He wants to make his first 5 investments. What would be give us a 5 bullet point to-do list or 5 things that you think they should look out for, and maybe a few steps or tasks that they should perform before they make their first investment?
So I would say number 1, don't rush. You are in no rush to like invest in startups. Wait for the one or two, or whenever, however many you want. Wait for the quality ones to come through that you have a high conviction on. And that's an advantage that equity crowdfunding investors have over VC. So venture capitalists, when they get money from their LPs, that's basically just who funds venture capitalists, they usually have an investment horizon that they like. They have to deploy all the money by a certain time period, otherwise they have to return that cash to the limited partners. And so their clock is ticking, and they have to like deploy this cash. So they sometimes, they just put it into companies even if they're not fully sold on it, because they have to. And with equity crowdfunding, it's your money. You're on no time horizon other than your own. So take your time with it. Like, you don't need to like immediately throw like all your money into like all these startups. So that's one. Two, just look at as many deals as you can. What looks like a great deal right now, after you look at 20 others, might not look as great, because you'll sort of get a better feel for like what valuations make sense and stuff like that. So I would encourage you to do that. Three, ties back to the ad, like look at the Form C. The Form C is really important. Like that's what they have to submit to the SEC. Not that they would lie on their funding page, but they cannot lie on the SEC. Like, they have to provide like audited financials and stuff like that. So that one's really good to look into. 4, let's see. I think sort of make a checklist for yourself. So when I had the Crowdscale rating, which was like the score out of 100, it was 5 categories that went into it. I think it was founder strength was one of them. Total opportunity. A lot of people call it TAM, total addressable market. Look at their competition. That's a key one, because when you look at the fundraising page, they're not going to like shout from the hilltops that there's like 30 other competitors in the space. Like there's a lot of like beverage brands that do equity crowdfunding, and it makes sense. Like, it's a consumer product, so get your community behind it, let them be investors. But like, there's 1,000 like whiskey brands. So like, do your research into the competitors. Like, there might be 3. I don't know if it's like a Irish Canadian whiskey. There might be 3 Irish Canadian whiskeys out there already. So like, look at competitors. It's not going to be on the fundraising page. You got to Google search and like see what they're doing.
I'll add to that, because I invested in a crowdfunding beverage company. Just go out and try it. And if you don't like it, that should be part of your investment, because if you don't like it, that means probably somebody else isn't going to like it. I like the one I invested in. That was part of my criteria. But go ahead with number 5.
What were your 2 investments, by the way?
Yayo Tequila, which was we had him on episode 15, and then the Caddy Kiosk, which was
I talked to Tyler. He's a good guy.
I really like what they're doing there. I'm a golfer myself, so that played a part in that. I think it's a really, really good idea. So they just had a actually pretty big thing with the city of Seattle. They signed a partnership with them, so I'm excited to see what they go with that.
Yeah, totally. And I guess I'll just round out with number 5. I guess like tap into the power of equity crowdfunding. Like, not to get like super cliche, but like the whole point is that it's the power of the crowd. And like there's a Facebook group called Start Engine Trading or Start Engine Investors or something like that. It's about 4,000 members or 3,000 members. And it's an active community where you can just post your questions. Like, for example, let's say you're looking at like I don't know, like a wrestling gear startup, whatever. Like, you can ask the crowd, be like, "Hey, is anyone here in a past wrestler, or like know any wrestlers? Like, would love to get your like expert opinion on this." If there's 4,000 people in a group, there's chances are there might be someone that like can give you in-depth experience and knowledge on that. So that's our advantage, and you got to use it.
Yeah, those are some great points.
Yeah. So I think this is a good way. We're kind of getting towards the end of our time. So we're going to go rapid fire questions. 1 sentence answer.
All right.
Crowdfunding rapid fire. Okay. Number 1, favorite crowdfunding platform.
This is tough to do in 1 sentence. I actually, sorry, this isn't going to be rapid fire answer, because this is
Don't worry about it.
But
Pseudo
I
rapid
looked
fire.
I looked at the distribution of my investments before doing this interview. Right now, I have a dead even split between my investments on WeFunder and Start Engine. They comprise of 35% of my investments each, and then 19% on Republic, and then 11% on other platforms. And so my top two are WeFunder and Start Engine. I would say WeFunder is sort of better for investors because they offer a lot more preferred shares, basically like liquidation preference. If things go sideways for a company, you're going to do better in terms of how much money you get back because you're higher up in the liquidation preference for a lot of their deals. And then I would say Start Engine because I have the owner's bonus, which allows me to get free shares on top of my investment. It's like you pay $200 for a year to be a member of this, and you can get bonus shares in a lot of the companies that list on their site. So that is also friendly to investors.
Besides the cell, favorite startup raising right now?
Either Atom Beam or Triogenics. Triogenics, it does basically they have a completely alternative to wisdom teeth removal. It's not super invasive. It's not painful. It's relatively cheap. So it makes so much sense, and I would be surprised if that one doesn't do great things. And then Atom Beam compacts data, and it's a little bit more of a complicated one, but it's a very needed solution right now.
Connor, you got one?
Yeah, how much do perks play a part in making an investment for you?
How much do perks play a part? So they don't play a part in terms of whether I'm going to invest or not. They play a part if I'm going to invest I don't know, 1,000. Let's say I'm going to invest $800 anyway, but the perk level, I can get
something at
lunch
1,000
or something at $1,000. Yeah, it might sway me, but it never changes yes or no. I'm going to invest. It just changes
how much. Okay.
Yeah.
Favorite platform, and then how about what do you think the first big exit in equity crowdfunding is going to be? What company or what startup?
That's a tough one because I don't there's startups that have been raised before I even got in the space, so I might be missing some ones that are stealthily growing like crazy. I would say Boxable's already huge. They've been the poster child for equity crowdfunding. They have something crazy over 40,000 investors in this one company.
It is insane what they're doing. It is
Don't they sell out within 24 hours too? They close their rounds within 24 hours?
Some of them, yeah. It's insane. They have Facebook groups of just fans. People are if you think Facebook is a dead platform, which has some merit to it, it's really gone downhill. But if you think Facebook's a dead platform, I urge you to go to a Boxable investor or Boxable fan page, and there will be 10 posts a day. Every single post will have 80 likes and 30 comments. There's a lot of excitement around Boxable.
Okay, I can see that.
Yeah, Boxable is it's one of those things where you kind of just sit there and you look at their campaign page and you're like, this is gonna work. This is a really interestingly awesome company that has a great product. So I have to agree with you there. I actually think you're right on that one. Kevin, thank you for your time. You sat with us through 48 minutes, so that's a pretty long time to be with me and Connor. But thank you for taking the time out of your day, and we really appreciate it. And I feel like I actually learned a lot from you. It's always nice to talk to people in the space and learn a thing or two, and be able to connect.
Well, and before you go, real quick, obviously all the listeners should be subscribed to Crowdscale, but if they're not, tell them what they're missing out.
Oh yeah.
If you want someone who is in your shoes, but maybe 3 or 4 years ahead of you, and you can avoid all the mistakes that I made, go check it out. I'm still making mistakes, but I'm getting better, and I have a little bit of a knowledge base to pull from already. So it's super relatable, and it's, in my opinion, super informative. So I have the newsletter. It's free. So there's really no downside to subscribing. So yeah, go check it out.
Sign up. It's some of the best newsletter content out there, especially it's the best for equity crowdfunding, 100%. So if you're listening, sign up 100%. And Kevin, thank you for putting it out there for the equity crowdfunding community. We appreciate it.
Yeah.
Thank you.
Link will be in the description, and that's at Crowdscale1 on X. And so I guess for all you listeners out there, make sure you like, comment, subscribe. We really appreciate your support, and go out there and support Kevin in his newsletter as well. So with that being said, we will see you next time on Next Big Thing HQ. Whether it's This Week in Crowdfunding or another great interview, we look forward to bringing you the next episode. So long.
Bye-bye.
Thanks, guys.
Thanks, Kevin. We appreciate it.
Yeah. Thanks so much. This is a fun interview. I'll tighten up my